BlackRock. The name itself sounds solid, imposing, like a force of nature. And in the world of finance, BlackRock is a force to be reckoned with. Founded in 1989, BlackRock has grown into a behemoth, managing trillions of dollars in assets. They are the world's largest asset manager. BlackRock's reach extends across the globe, investing in everything from stocks and bonds to real estate and infrastructure. This immense portfolio gives them unparalleled influence in the market. What BlackRock does sends ripples throughout the entire financial system. Their decisions impact what companies succeed, what projects get funded, and ultimately, how our economy functions. Think about your retirement savings, your pension fund. Chances are, BlackRock has a hand in managing those funds. They're invested in the companies you buy from, the services you rely on. BlackRock's influence is pervasive, touching nearly every corner of our lives, whether we realize it or not. But this immense power raises a critical question. Is BlackRock simply a successful player in a free market? Or has it become too big, too dominant? Has BlackRock's size tipped the scales, creating an uneven playing field where competition is stifled and consumers are left with fewer choices? In a truly free market, competition is the engine that drives innovation and keeps prices in check. But what happens when a single player becomes so large that it casts a shadow over its rivals? This is the question being raised about BlackRock. Their sheer size and scope have led some to argue that they are edging closer to monopoly status. Critics argue that BlackRock's dominance allows them to dictate terms in the market, potentially squeezing out smaller competitors. This lack of competition, they warn, could lead to higher prices for consumers and fewer choices in the marketplace. Imagine a world where your investment options are limited, your choices dictated by a single powerful entity. Furthermore, concerns have been raised about BlackRock's influence on corporate governance. As a major shareholder in countless companies, BlackRock has the power to sway corporate decisions, potentially prioritizing their own interests over those of individual investors. This concentration of power, some argue, undermines the principles of a free market and threatens to create an unaccountable corporate elite. The debate over BlackRock's influence is complex and multifaceted. Proponents argue that their size and scale allow them to achieve economies of scale, benefiting investors with lower fees and greater efficiency. They point to BlackRock's track record of success, arguing that their dominance is simply a reflection of their expertise and market acumen. The debate over BlackRock's influence is not merely an academic exercise, it has real-world implications for American consumers and investors. If BlackRock's dominance is allowed to go unchecked, it could have a profound impact on our economic freedom and opportunities. One of the most significant concerns is the potential for reduced competition to lead to higher prices. When a single company controls a large share of the market, they have greater leverage to set prices, potentially driving up costs for consumers. This can be seen in industries ranging from healthcare to airlines, where consolidation has led to fewer choices and higher prices. Moreover, BlackRock's dominance could stifle innovation. In a competitive market, companies are constantly striving to develop new products and services to gain an edge. However, when one company becomes too dominant, they have less incentive to innovate. This can lead to stagnation and a lack of dynamism in the market, ultimately harming consumers who are left with fewer choices. The concentration of power in the hands of a few giant corporations also threatens our economic freedom. In a truly free market, individuals have the power to choose where they invest their money, what products they buy, and what companies they support. However, as companies like BlackRock become more dominant, they gain greater control over these choices, potentially limiting our options and shaping the market in their own interests. The concerns about BlackRock's market dominance are serious and warrant careful consideration. However, it's essential to remember that this is not an insurmountable problem. There are steps we can take to address this issue and create a more balanced and competitive economy. One crucial step is to strengthen regulations aimed at preventing monopolies and promoting competition. Antitrust laws designed to prevent companies from gaining too much market power need to be enforced more rigorously. Additionally, policymakers should consider implementing new regulations specifically tailored to address the unique challenges posed by asset management giants like BlackRock. Another critical strategy is to promote diversification in the market. This means encouraging the growth of smaller asset management firms and creating opportunities for new players to enter the market. Governments can play a role in fostering competition by providing incentives for small businesses and startups in the financial services sector. Finally, raising public awareness is essential. Many people are unaware of the extent of BlackRock's influence and the potential risks it poses. By educating the public about these issues, we can empower individuals to make more informed decisions about their investments and hold policymakers accountable for creating a more competitive and equitable economy. Addressing the issue of corporate concentration and market dominance is not about demonizing any particular company. It's about safeguarding the principles of a free market and ensuring that our economy works for everyone, not just a select few. By taking action to promote competition, diversify the market, and raise public awareness, we can create an economy where power is more evenly distributed, innovation thrives, and consumers have genuine choices.